Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of those crazy corporate filings. Today we're diving into Tianci and Tianci, and let me tell you, it's a bit of a roller coaster. It's like they're trying to navigate a stormy sea with a leaky boat. Hopefully they have enough buckets. We'll be decoding their financial health, business strategies, and maybe even a little bit of corporate drama along the way. First, let's jump right into their balance sheet. Think of this as a snapshot of what they own and what they owe. Okay, so their cash is down. They went from $413,190 last July to $180,554 in January. So they're spending more cash than they are bringing in. They've got about half the cash they had 6 months ago. It's like they're running low on fuel and they better find a gas station quick. Next up, deferred offering costs, a bit technical, but basically costs they hope to recover from selling stocks later on. This increased slightly from about $495,000 to $569,000, so they're investing $9,000 to they're investing more to prepare for a stock offering. Now, let's look at the liability side. Income taxes payable decreased from $62,204 to $17,175, meaning they paid their tax bill at least partially. Finally, big picture for the company, their carrying accumulated deficit is up from $22,071 last July to $428 and $478. They are losing money. Now, let's move on to their income statement, which summarizes revenues and expenses over a period of time, like a movie of their financial activity. Their total operating revenues decreased to $279,203, $94,128 a year ago, which is a 28% drop. It looks like their main business, global logistics, isn't bringing in as much dough, which isn't a great sign. Now, the cost of those revenues is down to $1,999.90, $925,000, $2045,000 as compared to $2,555,000, $2040 as a year ago. That left them with a gross profit of $79,178,000, a $149,104 they made a year ago. That's a whopping 76% decrease, like taking a huge pay cut. Looking at operating expenses, general and administrative costs went up to $171,211 from $136,721. It seems they're spending more on running the business, even though they're making less. All that adds up to a loss from operations of $106,269 last year. Zooming out, we see a net loss of $110 and $971 compared to a net income of $100 and $714 last. A lot of money as compared to a profit last year. Breaking it down per share, they lost about a penny per share. Okay, let's look at cash flow. Cash is king, so where did their cash go? Starting with operating activities, so after adjusting for a net loss of $202,990.19, they ended up burning $158 and $458 and $458 and $458. The company also went through a net cash for financing activities after spending money on payments for deferred offering costs of $74,125. Putting that together, they ended the period with cash decreased as compared to before, meaning they need to generate more revenue or get some financing to get cash flowing better. Stepping away from numbers for a second, let's get a sense for what this company does. Turns out Tianci is a holding company and they own some global logistics services including ocean freight forwarding and related logistics solutions, distributing electronic components and providing software services. Think of them as managing the movement of goods around the world. Interestingly, they had an agreement with Prime Number Capital for a stock offering, but there's no assurance that the offering will occur. This could mean they're struggling to secure the funding they need. Diving in on related parties, RQS Capital, a major shareholder, is owed some money from the company. It's a small amount, but something to keep in mind. They also pay their officers and directors pretty well, between $3,300 each month. Peeking at the risk section. Interestingly, 2 customers make up half of the company's revenue, meaning losing them would be a major hit. They are also very reliant on a couple of key vendors. Turns out they had a lease for their office space in Hong Kong that was terminated early. They are renting a new place in Hong Kong for pretty cheap. Finally, we scroll to the end and see the company's management stating it's all good with no reportable subsequent events. On the downside, they are acknowledging some serious control problems due to a lack of staff and formal review processes. That could cause problems. And with that, the executives sign off And we are done reviewing Tab Air. What do we make of all this? I'd say not great. Their main logistics business seems to be slowing down and they're not effectively controlling costs as the company is losing a lot of money. While the company is generating a lot more revenue in the last 6 months as compared to the prior year, the business is actually worse off than it was before. On the upside, their asset-light logistics strategy gives them flexibility. Plus, the Asia-Pacific region is huge and there's plenty of growth potential there. The bad thing is they are very reliant on 2 customers and they must fix their cash flow management. There are better investments out there, but who knows, they might pull a rabbit out of the hat and fix this leaky boat after all. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, hit that like button, drop a comment, and definitely subscribe for more deep dives into the world of corporate finance. Until next time.